Hi everybody, it's Thursday, December 4th, 2025. Headline today is Initial Jobless Claims Shockingly Low. Recession Canceled? Initial jobless claims for the week of November 29th was reported to be 191,000, the lowest that it has been since 2022. Before this report, I've been noticing that since January of 2024, we've had a series of higher highs and higher lows, and I've been waiting to see when, not if, this was going to explode higher, and it was shockingly low. Lows we haven't seen for years. Now, whether you trust the data or not, this is the data. In my opinion, if the Fed uses government data to make Fed policy decisions, and we have high inflation and initial claims is collapsing, why cut? When you combine all of the expected cuts in the Fed funds futures, you can see what's going on in the 2-year Treasury note yield. And it barely budged today. And so this market, to my eye, is not seeing this initial claims report as valid or lasting long. The Fed funds futures still shows an 85% chance of a 25 basis point cut for the next FOMC meeting in December on the December 10th. And looking at the Fed funds futures themselves, in addition to the almost guaranteed cut in 1 week from now, we still see 2 or 3 more cuts in 2026. So the way I'm interpreting this data is that the market either is interpreting it as either false or temporary in the initial claims. How can you say that you need to cut rates if inflation is still too high and no one's claiming unemployment anymore? Maybe they've just stopped believing the government data. As you remember yesterday, ADP employment, which is private, not government data, we were expecting added 40,000 jobs, and we got negative 32,000 jobs. 4 of the last 6 months being negative in this reading. If initial claims being shockingly low is canceling the recession, the market's not believing that, not yet anyway. Moving on to our community topics. What moves, if any, did you make today? Did you buy anything, sell anything? Robschild sits on hands. Tomorrow, look out for personal savings, personal income, personal spending. We also have PCE. This is the Fed way of looking at how inflation is. We also have consumer sentiment for December, preliminary report coming out, and some big things later this month, as well as those constant tariff updates. Thank you so much for watching, liking, subscribing, sharing, commenting, and all of your support. It's been a few months since I did an update in my website. I do have an update now, if you didn't catch it. Just updated some things that were getting a little out of date, reworded some things. This website is free in the description. Click on it below. I also have a portfolio explained, the Robschild portfolio. This is my own personal way of investing. None of it's advice. It's just what I'm doing for interest, for education more than anything. If you think my daily videos are worth 10 cents per video, $25 a year is the equivalent. Many of you have supported me greatly, and I greatly appreciate it. Let's move on to the charts today. SPX, the S&P 500, opened higher, closed a little lower, making a bit of a hangman candle. That candle on its own is not very bullish looking, and yet it does not negate the fact that we are starting to look like we're forming a bit of a bull flag here, consolidating after this move up. The close was higher on the day by 0.1%. However, the advanced decline line looks like it went completely flat today, which is a little sign of caution. I noticed that the VIX, which measures the volatility of the S&P 500 using the pricing of options contracts, closed at a low, pretty much in line with the low we saw at the end of October and previously not seen since the end of September. While it seems very low based on recent history, it can go lower. We are considered to be, in my book, in a healthy range, not in a complacent one in terms of the level of the VIX right now at 1579. TLT, my favorite place to be. I need to bring up a pattern that I've been noticing on TLT. I'm just going to draw it for you here. We do have a head and shoulders, not only a head and shoulders, very scary looking head and shoulders. That reminds me of some video games that I play where you have, the spiky things on the shoulder and then the actual shoulder to the head. And look how symmetrical that is. Just interesting. Now that I'm drawing it, it looks a little like a spaceship. So if this does end up playing out as a head and shoulders and we break and confirm below this and retest, TLT in the short term definitely could go lower. With that said, I find that yields in general, especially TLT, especially long yields, tend to ignore head and shoulders patterns similar to silver. It seems like both of those areas, especially in shorter time frames, tend to not play out as you expect them, especially considering that this isn't like, typically for a head and shoulders, you want it to be at the very top of a long run. We can't really call that where we are right here. We have gone up since the end of May, but scrolling out further, looks more of a sideways chop than anything. However, if this were to play out, just doing a rough estimate, head to neck, and then the break, is TLT headed down to 85? After all, this is a very symmetrical looking head and shoulders. We'll see what happens with that. The MOVE index doesn't agree that volatility in bonds will be increasing. Typically, when the MOVE index is dropping, which measures the volatility of bonds, that's typically bullish for longer bonds. And we dropped further today, hitting the same low that we hit at the end of October. And that same low hasn't been seen actually since 2021. The MOVE index has been falling pretty strongly, since, for the whole year of 2025 at least. You can see from the beginning of April, this has been really falling. And while we're talking about chart patterns on duration treasuries, obviously the 10-year treasury note yield has a similar inverse head and shoulders. When yields go up, TLT goes down. But short term, like I've been saying, we've entered back into we're exactly at 4.1 today on the close. It's same range as we've been in all of November. And I want to remind everybody, we're below, sorry, I hate when it does that. We're below this purple trend line here, connecting the May high to the July high to the November 21st high. And that line actually represents the top of a larger, big head and shoulders. If you can see it, this purple head and shoulders here, starting back in August of 2022. Based on the fact that this right part of the right shoulder has held so far, I do think there is a possibility that the long yields will be dropping very far, a lot further than most other people expect. If this head and shoulders pattern plays out, the target for the 10-year treasury note yield, by the way, is 2.24%. And if the recession is not canceled, if the Fed is forced to not be as dovish as they otherwise would be because of the fact that they have to deal with inflation, this has been my crystal ball rating for a long time. I think this cycle, this business cycle, the Fed is not going to cut fast enough to save the economy, like I've said on many shows before. And if that's the case, it's not actually hard to imagine us dropping that low in the 10-year treasury note yield. Just to remind everybody as well, on the longer term basis, since 1980, the 10-year treasury note yield has been falling, and we haven't been in this range, this high in the 10-year treasury note yield, since the 2010. Only, briefly, we were really in this range, from 2003 up until about 2008. And from this viewpoint, you can see that yields can drop, and they can drop really far, really fast. And so it's not out of the realm of possibilities, in my opinion, that the 10-year could drop that low. And I know some people are even thinking that we're going to be slamming back down to zero. The best counter argument against that, again, is the fact that with fiscal spending, as long as the government keeps spending more than they're collecting in taxes, that can keep rates elevated. Lynn Alden, she predicted this correctly, that there would be higher yields, and part of her prediction was finding a higher low in this cycle. And so this is what I am wondering, since the pandemic, we went up, is this going to be the higher low that she's talking about before maybe going higher? I know a lot of people are convinced that we're in a longer term debt cycle where, you can have decades of yields dropping, and then you can also have decades of yields rising like they did from, the late 1940s until 1980. That whole period, the 10-year Treasury note yield was rising. So with the Robschild portfolio, I am willing to bet that the 10-year drops at least to 3.6%. And below that, I'm thinking of, basically stop lossing at some point, because I'm not willing to bet that rates are going to be dropping that low. But I find it interesting that this longer term chart pattern kind of shows that possibility, the purple there, that head and shoulders. And on a daily basis, it seems like we might be at the end, very near the end of this pattern. Moving on, next up we have Bitcoin, looking like we are still in a pattern of higher highs, higher lows, probably getting to the magnetic trend line again that we connect August 2024 to April 2025. I think the Bitcoin is headed there, and I'm willing to short there at 98,000. Next up, the dollar index, getting a bounce today, closing above the bottom of this end pattern. So, like I said yesterday, more neutral than anything, and even more neutral now that we've closed back above the red line I have there. Crude oil today is fighting this line again. And so I'm wondering, like I've been mentioning on various previous shows, if Gareth Solway is right that oil may be breaking out soon. After all, we have 1, 2, 3, 4, that's the fifth hit, weakening this trend line. So, and then remember on Tuesday we were falling. It looked like we were headed back down and then back up. We didn't. So we weren't even able to go back down to the lower trend line. And so the chart is starting to look a bit more bullish right now. Metals basically paused today. Copper went sideways. Gold went sideways. I mentioned silver. I said there was 3 possibilities after slowing momentum to the upside. I said we're either going to go straight back down or consolidate here and fight higher. Today's red candles is beginning to look like more of a blow off top, but we definitely still could consolidate here. So looking to me more neutral than anything else for now. I know there's news about the Japanese longer term yields going up to the point where it's going to unwind a lot of carry trades. Some people are even predicting that it could end up being a pretty big disaster, financial disaster kind of a thing, where so much leverage has to unwind that it does a lot of damage to a lot of charts. But I found it interesting today that the Nikkei 225 rose by 2.3%, looking bullish any way you look at it, with higher highs, higher lows, also breaking above. That's not a very good trend line. Breaking out of this and confirming higher. And it's not like it's because the dollar was still dropping. The dollar did not drop today. Also, EWZ, one of the largest holdings in the Robschild portfolio, still have my finger on the sell button, but I think a more fair value still is around $42. I've been saying on show after show after show, this is accelerating momentum to the upside, and it still looks like it's doing that. Also, on very recent shows, I have been mentioning that the Baltic Exchange Dry Bulk Index has been skyrocketing, continuing to skyrocket today. This is a big signal that the Chinese economy is potentially pulling out of its glut. Shipping rates spiking like this is screaming demand for stuff. And like I've been saying on recent shows, the U.S. economy often follows China. So, hey, maybe this initial claims shocker is the reality, and maybe the Fed shouldn't be cutting right now. Combining everything together, markets are getting really, really interesting right now, with so much of the stock market so overvalued and everything, and it can go higher. I mean, look, the junk bond credit spreads continuing to fall. Like I always say, below 3% for me is complacent. You're really supposed to demand a higher yield for junk debt. When it's below 3, it's a bit of a warning sign to me. It adds to the potential momentum of an unwind if that occurs. Last little detail, the 10-year break-even inflation rate. Yes, we're still in a pattern of lower highs and lower lows. Today's reading kicked up a little bit. Lots of different signals from different charts, from different markets, all telling slightly different stories. Which ones will be right and which ones will be wrong? You'd need a crystal ball for that one. And that's all from me and my crystal ball. Hope you enjoyed. Thank you for watching, and see you next time. Robschild.